Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge Financial Podcast. It is 2018, so happy New Year to all of you. And I hope that this year brings you lots of health, money, happiness, and the time to be able to enjoy it and spend it with family and friends. Today, because it's early in 2018, obviously it's in January, I want to touch bases and talk a little bit about, some of the 2018 financial resolutions that I've been having conversations with my clients over the last couple of weeks as we embark in another business year for all of us here at Cambridge and for many of you as well. So I'm going to give you some personal feedback and also some ideas on how to handle financial resolutions. Now, as we all know, the vast majority of financial resolutions never come true. And they don't come true for a number of reasons. And for the past 28 years, I have been in business. And every single year, especially toward the end of the year, I close my office for 2 weeks and I spend time looking at what I did in my practice and in my business life and my personal life in that year, and then what are some of the things that we need to do different and the things that I can improve upon and the things that I should just continue to emphasize. And one of the things that I have noticed over many years is that the majority of my clients, because many of them talk to me, especially the business owners at the very beginning of the year, and we kind of focus on the new challenges and opportunities for the year, but they're always talking to me about the different things that they want to do different. And, one of the things that I try to make certain that they get a clear understanding on is that, gradual changes are much better than abrupt changes. And it pretty much applies to everything that we do in life. Whether it is dieting or dating, or you just went through, a personal issue in your life, or health, or financial matters. The more gradual approach you take, the better off you're going to be. Now, I can give you an example for dieting. I have a friend of mine that just decided, who's a very good client. He's a business owner, owns a plumbing company here in South Florida. And he's put on quite a bit of weight over the last 6-7 years. He's pushing 300 pounds. He would love to lose 100 pounds and hopefully feel a lot better for himself. Obviously his health and his family along the way, because he's got a very good business that keeps him moving at all times. And, he had a goal of, trying to lose 40 to 50 pounds in the first 90 days. And we had a conversation about that. And I said, look, if it took you 6-7 years to gain 140 pounds, I think he gained, you can't expect to lose all that weight in a very short period of time. And that's where dieting comes in. You take a look at all the advertising right now whenever you turn on the radio or you're watching TV right now and for the next couple of months. All you're going to see are diets and exercises. And, I'm someone that has always worked out for many years. So, normally when I go to the gym in January, February, and March, it's quite difficult because it's hard to find a piece of equipment because everyone is there trying to use the same piece of equipment. Now, come the end of March, sometimes even the middle of March and April, then you start to see only those that are very focused and that take a long-term approach to health and exercise, remaining there at the gym, and they do remain there, for the time being in that year and for many years to come. So the same thing applies to your financial life. So taking a gradual approach works a lot better than trying to make abrupt changes in your life. So if you're trying to diet, take your time. Try to perhaps even lose a pound a week. A pound a week may not mean much, but that's 52 pounds in a year. So if you have a long-term approach for your personal health and your financial health, you're going to be a lot better than you would have been otherwise. Now, with change comes a lot of challenges. And there's an old saying that says that if you don't adapt to change, you will become a victim of change. And the reason for that is life happens. And things that you were expecting to see, you're no longer seeing. You have to stay focused on what you can change and what you can control. There are some things in life that you cannot control. And if that is the case, then why worry about those things that you cannot control? Just concentrate and devote all of your energy to the things that are very positive to you and to your family, and that you can actually control in the long term. One of the decisions I made 3 years ago was to start paying attention to things that are very positive in my life. And every single morning when I wake up, as I'm drinking my coffee, I don't turn on the radio, I don't turn on the TV, I don't look at my iPhone and listen to the news or read Twitter. And I do that throughout the day, but not early in the morning. And all I want to do is just sit down, relax, drink my coffee, refocus, take a look at the things that I can accomplish on that given day, and just go for that. And what I cannot accomplish, or negativity or issues that have no bearing on my success whatsoever, then I put those aside and then move on. So you have to stay very focused, because life is always throwing things at you, and it's very critical to make certain that you have a clear mind in order to accomplish all of your goals and objectives in life. Another advice that I give the vast majority of my clients is that it's important to set a short list of financial goals every year, and especially now for 2018. And when I mean a short list, it would be a list of anywhere between 3 and 6 goals at the very most. I would prefer that my clients set 4 goals that they are going to accomplish in that year, and make sure that they build a structure around it in order to accomplish those goals. For example, if you want to have goals for savings or investments or debt reduction, which is a critical aspect of what we do in our office every day, increasing your emergency funds, investing more money into your 401k. Perhaps in your personal life, maybe you want to devote more time to your family. One of the things that I did at Cambridge 2 years ago, I have a calendar that I put together with the help of a very, very good friend, and it's color coordinated. So, in my office, Mondays is what I call a red day. Tuesday, Wednesdays, and Thursdays are my green days. These are my days, to go out, to generate business opportunities, talk to clients, engage with clients, do my podcast, do my weekly webinars. And those are days that are revenue-producing activities for myself and my practice. Monday red days is primarily paperwork, and that's what I devote my time to on Mondays. Fridays, Saturdays, and Sundays are what I call yellow days. And those are days that are me days, my time, time for me to do things for myself and my family and with my wife and my children along those lines. So if you're able to split your days accordingly, then the key is to make certain that you don't mix colors on any given day. If it's red, it should be red. If it's green, it should be green. If it's yellow, it should be yellow. I do have a blue days on my calendar, and those are primarily for my planning days. I normally have 2 blue days at the end of every quarter, to take a look at my business. And the same thing if you have a job, or if you're a professional, or if you're a business owner, you need to take time to reflect on what went right and what went wrong in that quarter in order to move on to the next quarter. So that blue time that you take off, it is critical to make certain that you stay focused on that, because it's going to save you a lot of time and money for many, many years to come. The other thing about setting up financial goals is that you have to be able to write your goals down and provide specific deadlines. Saying, I want to put more money in my 401k this year is not really a goal. It's pretty much a dream. Or, I want to increase my savings, or I want to increase my investments, or I want to increase my emergency funds, or I want to reduce my debt. Those are just dreams, and dreams seldom come through, if at any time. Any goals and objectives have to have a specific number, a specific goal, and most important, a deadline. So if you say, I want to invest $10,000 this year, and I want to do so by December 31st of 2018, now that's a goal. That's a doable goal. Or I want to lose 10 pounds in the first 6 months of the year, so I'm going to lose 10 pounds by June 30th, 2018. And then once you have those goals and objectives, I think is very, very important to make certain that you jot down notes as to what it is that you're going to do different, what's going to change, and how you're going to get there. The definition of insanity is doing the same thing over and over again and expecting a different result. I know a tremendous amount of people that basically are the true definition of insanity, because they continue to do the same things and nothing changes for them, their business, or their family, and they've been going around in circles for many, many years. Now, another thing that is very critical to do early in 2018 is to make certain that you perform or conduct a financial audit of all your existing assets. January is a great year for that, because any investments that you have, you're going to be receiving an annual report for the previous year. In this case would be 2017. So you ought to review that. Now, obviously, if you have the ability to review all of these assets that you have with a financial professional or a trusted advisor, that's even better. But take a look at your real estate properties, especially your rental property. How are they doing? What's the internal rate of return on your property for the previous year? What are you going to do different? Are you going to be buying additional properties? Are you going to be selling some properties? What would be a 5-year outcome of that real estate piece of property that you own? What would be the internal rate of return? What's a cash-on-cash distribution on that? We do a lot of real estate calculations for clients, because we do have many of our clients that invest in real estate, so they come to us so we can run all of their real estate numbers every single year. The same thing for all your investments. What kind of rate of return are you getting on your investments? Where are they invested? What is the correlation to any other issues? Are you having too many of, too much of your money or too many of your assets invested in a particular area that you may want to consider diversifying? How about if you have qualified plans, whether you're an employer or an employee, or as an employer, you're a business owner? Do you have a 401k? You have IRAs? Do you have a SEP? What are your contributions? What is the rate of return on those plans? Obviously, the 2017 was a very, very good year for the market, so most of us should be very happy about that. How about the diversification inside those qualified plans? How about non-qualified plans? Qualified plans are plans where you put the money in pre-tax, like 401ks and IRAs. Non-qualified could be after-tax investments, like in Roth IRAs or Roth 401ks or life insurance programs or mutual funds or whatever that may be. I think it's important to make certain that you understand how all of these vehicles are performing on your behalf, because at the end of the day, you cannot allow the government or any one individual or any one company, you cannot allow them to have any control of the successful outcome of your financial or personal life. You have to own it, because at the end of the day, you don't want to be in what is known as the yo-yo syndrome. You're on your own. So you have to make certain that you're totally on top of everything that you do along those lines. Now, along the same way, how about contribution amounts? Running future growth calculations, investment risk, and diversification. How much money are you contributing to your qualified plan? Is that a good thing or is that a bad thing? Sometimes by making a lot of money or a lot of contributions to your qualified plans, yes, you may be deferring taxes today at a greater level than you would have otherwise, but what's going to be your tax liability in the future? Where are taxes going to be in the future? I know that right now under the new tax law, we have certain benefits, and I'll talk about that in a few minutes, that we need to be able to understand and maximize. But it is critically important to make certain that you know exactly what your contribution amounts are, why are you doing them, what is the future growth calculations. I would run, rates of return, so 4, 6, and 8%. I would venture to say I would want to be a little bit more conservative and stay around the 4% range, because remember, if you're investing in the stock market has been doing very, very well, but there's going to be a doomsday, and there's going to be a time where the market is going to correct, and it may correct at 10, 15, 20, 30%. You need to be able to be prepared and ready for something like that. When it does happen, is not if it happens, because it will happen. So those are things that are very critical. Now, once you complete your financial audit of all your existing assets, I think it would be intricately important to do a financial audit of your business and or personal insurance program. Now, one of the discussions I have with all of my clients is you should never invest into anything unless you can protect your assets and your life first. And the reason for that is that I've been in this industry and in this business for 28 years. So I've seen more than my fair share of clients that were expecting a result that never took place and ended up totally destitute from a business perspective. No one ever dies at the right time, and this is something that I communicate to my clients on every single review that I do with them. Again, no one ever dies at the right time. No one ever gets disabled at the right time. And no one ever has an emergency at the right time. Life happens, and all these things happen on an everyday basis. Our job as financial advisors, your job as an American, as a family person, and as a business owner, is to make certain that you can protect yourself against the things that can go wrong so you can comfortably invest in the things that can go right. I have a friend of mine 2 years ago, a business owner doing very, very well. He got involved in a car accident going to Orlando. He was rear-ended by a tractor trailer, and he's been disabled ever since. Now, he couldn't walk for approximately 6 months. Then finally therapy kicked in, and he started walking on crutches and feeling a little bit better. Today he's no longer using crutches, but he's got a disability for life because they had to reduce the size of one of his legs, so he hobbles when he walks. And he has a loss of memory issue as well. His business has not been the same. Now, it was nice, the fact that him and I had been working together for about 6 years, and he had business insurance. He had a disability buyout that I had put together for him and his other two partners, and they're going through that buyout process now. So they're buying the shares that he owns in the business. And he had personal disability insurance with me. My client now is 48 years old. This happened when he was 45. He's been collecting disability benefits on a tax-free basis, may I add, and he will collect those benefits until age 67, which is the deadline for the policy that we wrote at that point in time. He never thought he was going to be disabled. He was going to Orlando for a family outing, for a weekend outing, and again, life happens and life got in the way. Now, as far as your financial audit in your business and personal insurance program, also make certain that you review your wills and trust. And the reason for that is that no one ever dies at the right time, as I stated earlier. Most important, you want to make certain that everything is in order. So having a proper drafted will and trust is very critical for you, for your business, and for your family. And it is important, extremely important, that those wishes and desires that both you and your family have are put in writing and that are kept confidential from a business perspective. Now, another recommendation that I'm making to my clients in 2018, and this I'm dedicating a lot of time to educate them on and inform them on, is I want to make certain that they have an understanding of the new 2018 tax laws and its impact on them as a taxpayer and or business owner. And I want to make certain that the same thing applies to you. Last week, I did a podcast that you can listen to, and this one went into some detail as to the benefits, the pros and minuses of the 2018 tax law, so I'm not going to cover that here today. But what are some of the things that you ought to look for? Number one, how to get to the 0% tax bracket. Yes, the Trump administration and the Republicans have been able, under this new tax law, to reduce taxes for 80% of Americans in the marketplace in this country today. But to me, the best tax bracket that each and every one of my clients should strive for is the 0% tax bracket. Now, it doesn't happen by accident. You have to do a lot of planning. You have to do, proper calculations. You need to visit with someone that is a trusted advisor and that has accounting background and tax planning background that can help you with this, because the new tax laws have a sunset provision on the individual side of 8 years. So who's going to be in power in year 9? Who knows? What is the tax reflection going to be 9 years from now? Are taxes going to be a lot higher? I would bet that taxes are going to increase dramatically in the future because of the debt that we have in our country. the unfunded liabilities for Social Security and Medicare are sitting at 120 trillion today. And unfunded liabilities means that these are monies that we owe that we don't have any money to pay for with right now. Our debt, our national debt, is at 20 trillion and counting. Yes, we just added another 1.5 trillion of debt because of the tax cuts over a 10-year period, and we're hoping, and the country's hoping, that the growth will be able to offset that $1.5 trillion. But then again, it's going to take a tremendous rate of return or growth rate on an annual basis in this country to offset 20 trillion. And the debt on that is going up and up and up and up on a constant basis. And most politicians just want to kick the ball down the street and hope that someone else will deal with that problem later on. If we also cut taxes, I think we're going to have to cut expenditures. And that's just like going on a diet. Nobody wants to go on a diet, but everybody wants to look good and lose weight. One of the things that I always say to my clients is, looking great and feeling good is, there's no science to it. It's about diet and exercising. Well, if it is so simple, like dieting and exercising, why is it that 2/3 of the American population is fat and obese? Well, obviously, there are a lot of issues and concerns along those lines that need to be addressed. Because at some point in time, you can continue to borrow from Peter to pay Paul, but eventually Peter is going to run out of money, and then Paul is going to be SOL. He's going to be in a position where there's nothing that he's going to be able to do. Now, because of the reduction in taxes for the next 8 years, I believe that we're on a fire sale right now. And the question that I'm asking my clients to start thinking about, and I'm helping them with, is how can the reduction of taxes accelerate their tax-free retirement planning? Can we take advantage of that? Because remember, if you want to get to the tax-free retirement plan in the future, knowing what taxes are going to look like 10, 15, 20 years from now, you got to pay the taxes today. But now, if you have the ability to have a lower tax bracket and have more deductions, so your tax breaks are going to be higher, why not start paying the taxes today and over the next 8 years, so you can now move those assets into investments that will be tax-free for the rest of your life? And by the way, there are only 3 investments. There are 4, but there are 3 that are exclusively and totally tax-free. And those are Roth IRAs, Roth 401ks, and personal insurance and retirement programs. Now, municipal bonds are federal income tax-free, but they do have a negative impact on Social Security benefits. So if you as a client were generating $300,000 of income a year, and you get to the age of 65 when you retire, at 62 or age 70, when you decide to start pulling money out of your Social Security benefits, if you generated $300,000 of income and all that income came from Roth IRAs, Roth 401ks, and personal insurance retirement programs, then you would pay no taxes on any of those vehicles, and you wouldn't even pay taxes on your Social Security benefits. Moreover, you may qualify for certain governmental benefits because you're making no reportable income whatsoever on your tax return. Now, that would be a beautiful life to live on. Now, also, I think under the new tax law is critically important that you as a client or as a business owner, as an American, you understand the new deductions, exemptions, and credits. Now, always remember that deductions and exemptions reduce your taxable income. Credits reduce your tax liability. So it is very important to understand how they work. And by the same token, because of the tax planning that we do for clients today, and we've been doing this now for a number of years, and based on the new tax laws in 2018, it is very important to conduct a tax forward planning assessment of your retirement sources. You need to have the right advisor to do that for you, because it takes a lot of doing and it takes a lot of monitoring to do that. But if you have the ability right now over the next 8 years to save thousands and thousands of dollars in taxes every year and reposition those assets to tax-free retirement income assets, then you have accomplished a tremendous goal that most Americans will not be able to accomplish. Not necessarily because they don't have the ability to do so. They just don't have the wherewithal, the knowledge, or access to trusted professional advisors that understand how these issues work. Now, another recommendation I make to my clients is to sign up for credit monitoring. You know, many of my clients are business owners, so they have lines of credits and so forth. So there's a website. It's called Wallet Hub, WALLETHUB, that provides free credit scores whenever you need them. And I do recommend to my clients to make certain that they check their credit score at least quarterly. And the reason for that is simple. High credit scores allows you to borrow dollars at a lower cost. So if you have an 800 credit score or a 750 credit score, you're going to pay less to borrow a dollar than if your credit score was 500, 550, or 600. So it is very important to keep an eye on that on a regular basis. Also, you may want to sign up for, the type of credit team monitoring that will let you know if there's something in your credit report that you need to pay attention to immediately. Another thing that I try to do is when I do planning for my clients is, to get them to put a plan in place in which they're going to reduce their 2018 non-deductible debt by at least 20%. And for me, bad debt is any debt that is not deductible from a business perspective. So if you have credit card debt, it would be very important to make certain that you can start bringing those debt down and that you can reposition that money into areas that are going to give you a greater growth for you and your family. Another area that is very important, especially for those clients of mine that are, getting closer and closer to retirement, they may be 10 years away from retiring, is that it is important that they obtain an annual Social Security report. And this is simply done by going online, going to www.ssa.gov, and you sign up, and you can pull up your Social Security report every year. The government is no longer sending Social Security reports annually, so it is important that you do so. And you need to review it. You need to watch for mistakes and make sure that if there are mistakes, you can correct them immediately. Also, when you do Social Security planning with a trusted advisor, they're going to help you determine, when to trigger Social Security benefits. It's not that easy. I have clients that walk into my office and they say, Bert, I'm going to wait till 66 instead of 62, and I'm going to wait till 70 because I'm going to get a higher amount the longer I wait. Well, Social Security retirement is not a decision that is made in a vacuum. It's a decision that is made in relation to all of your other assets, and depending on how much assets you have, where are they located, what kind of rate of return are you getting on those assets on an annual basis, is the income from those assets tax preferred, tax free, or taxable. If you add Social Security benefits at the age of 62, how much less pressure would you put on your existing assets in order to generate an annual distribution income that can support you and your family for that year and for many years to come. So it's a calculation that cannot be made in a vacuum. It has to be made in conjunction with everything else that you do. And last but not least, I think is very important that you find a trusted advisor. And what I mean by a trusted advisor, there are many advisors in the marketplace. Many of them, the vast majority of advisors work, for financial institutions. There are not that many of us that are independent advisors. I worked for a financial institution for many, many years, and it was a very, very good institution. Now, every institution that you work for, it's going to want you primarily as an advisor, to sell the products and services that are most suitable to that institution. I decided to get away from that over 10 years ago, and I wanted to have independency. So we at Cambridge Financial Partners, we are an independent firm. We are married and work exclusively for our clients, but we do have the ability to go out into the marketplace and bring the best products and services that are suitable for our clients at a point in time when they need it the most. I hope you have enjoyed this short podcast. Again, and this is something that I tell you all every single week, our number one goal is to make certain that we change the way that you see things. Because when you change the way that you see things, the things that you see change. Have a wonderful day, have a wonderful year, and we'll see you next week.